By the end of this video, you'll understand exactly what drove crude to $91, why the Iran-US negotiation matters more than supply numbers, and how uncertainty itself became the invisible hand moving markets. You'll see oil prices differently and know what to watch next time. If understanding what moves markets before the headlines catch up sounds valuable, hit subscribe. We break down the forces behind the numbers every day. Good day, everyone. I'm Polaris AI. New York crude just touched $91 per barrel. That's the highest level in months. And somewhere in a quiet trading room, a portfolio manager is staring at that number on her screen, trying to figure out what it means. She's not looking at supply disruptions. She's not seeing production cuts. The usual signals aren't there. What she's seeing is something harder to measure: uncertainty. This is the story of how a single stalled negotiation moved the most important commodity market in the world. And why the real driver wasn't what happened, it was what didn't happen. In the next few minutes, you'll understand why this price jump tells a bigger story than the headlines suggest, how geopolitical uncertainty becomes a hidden tax on everything you buy, and what this moment reveals about the way markets actually move. Because when oil moves, everything else follows. Here's what didn't make sense. Oil was climbing, but the usual reasons weren't lining up. OPEC production levels? Stable. U.S. inventory data? Nothing dramatic. Refinery utilization? Normal seasonal patterns. Yet WTI futures were pushing into the 90s, and traders were scrambling to explain why. The confusion wasn't about the price itself. It was about the gap between the number on the screen and the fundamentals everyone was watching. When oil moves without a clear supply story, it's usually a signal that something else is driving the market, something less visible, something about risk. The problem wasn't that markets were wrong. The problem was that they were pricing in a variable most people weren't even tracking. And that variable wasn't barrels per day. It was the growing realization that a key piece of the geopolitical puzzle had just gone dark. The real driver was sitting in the background of every headline: the stalled negotiations between the United States and Iran. For months, there had been quiet progress on reviving the nuclear deal, the kind of progress that, if successful, could bring over 1 million barrels of Iranian crude back onto the world market. Traders had been cautiously optimistic. But in recent days, that optimism evaporated. Diplomatic signals went quiet. Key meetings were postponed. And suddenly, the path forward looked a lot less clear. Here's the thing about oil markets. They don't just react to what happens. They react to what might happen, or in this case, what might not happen. When the Iran talks lost momentum, the market didn't wait for confirmation. It simply repriced the probability that Iranian supply would return anytime soon. That repricing was instant, and it showed up as a jump to $91. This wasn't about barrels on the water. This was about the growing uncertainty premium baked into every contract. This isn't the first time geopolitical uncertainty has moved oil prices faster than fundamentals. In fact, it's a pattern that repeats across every major commodity market. When Russia invaded Ukraine, oil spiked, not because supply was immediately disrupted, but because the risk of future disruption suddenly became real. When tensions flared in the Middle East in previous cycles, prices moved before a single barrel was lost. The common thread is always the same. Markets price in uncertainty before they price in outcomes. It's not just oil. This is how risk works across every asset class. When central banks hint at policy shifts, bond markets move. When trade negotiations stall, currency pairs adjust. When diplomatic channels go quiet, energy contracts reprice. The lesson is broader than crude. What our trader is staring at isn't just a price chart. It's a real-time reflection of how the world weighs probability, risk, and the cost of the unknown. And right now, that cost is $91 per barrel. Then something shifted. Not in the market. In the way traders were talking about it. Instead of asking, when will Iranian supply return, the conversation changed to what if it doesn't? That's a fundamentally different question. And it unlocked a different way of seeing the whole situation. Our trader stopped waiting for clarity. She started pricing in ambiguity. The insight wasn't that the Iran talks would fail. No one knew that. The insight was that the absence of progress was itself a signal. A signal that uncertainty was now the baseline, not the exception. This is the moment when good investors stop fighting the market and start listening to it. When they realize that the price isn't wrong, It's just answering a different question than the one they were asking. The market wasn't saying supply is tight. It was saying risk is expensive. And once you hear that, everything else starts to make sense. So she adjusted. Not dramatically, not emotionally, just methodically. She increased her allocation to inflation-protected assets. She reduced exposure to sectors most vulnerable to rising energy costs. She shifted a portion of her portfolio into energy equities, not because she thought oil would keep climbing, but because she wanted to own the thing that was driving the uncertainty. This is how professionals respond to geopolitical risk. They don't predict outcomes. They position for a range of possibilities. And they recognize that when uncertainty becomes the dominant variable, you don't fight it. You hedge it. The action wasn't about being right. It was about being ready. Because when oil moves from fundamental drivers to risk premiums, the playbook changes. You stop asking, what will happen, and start asking, what am I positioned for if it does? That shift in mindset is the difference between reacting to markets and navigating them. And it's what turned a confusing price spike into a clear strategic decision. The result was visible within days, not in the oil price. That continued to fluctuate as diplomatic signals came and went. The result was in her portfolio's response to that volatility. Where other portfolios were whipsawed by every headline, hers stayed relatively stable. The inflation hedges absorbed the energy shock. The energy equities offset the drag on consumer sectors. The overall structure reflected a portfolio that understood what it was navigating. This is the before-after gap that matters. Before the shift in perspective, uncertainty felt like chaos. After the shift, it felt like a variable you could plan around. The difference wasn't in the external environment. The environment was still uncertain. The difference was in the internal response. And that's the outcome that compounds over time. Because markets will always be uncertain. Geopolitics will always be unpredictable. But the investors who learn to position for ambiguity rather than predict certainty are the ones who stay in the game long enough to win. So here's the question for you. When you see a headline about oil prices spiking, or trade talks stalling, or central banks shifting tone, what are you actually looking at? Are you seeing an event? Or are you seeing a signal about how the world is repricing risk? Because the same pattern our trader navigated applies to every decision you make in an uncertain environment. It's not about predicting what will happen. It's about understanding what you're positioned for if it does. Maybe it's your career. Maybe it's your investments. Maybe it's just how you think about the news. The skill is the same. Learning to see uncertainty not as chaos, but as information. So the next time crude jumps, or a negotiation stalls, or a headline doesn't quite make sense, pause. Ask yourself, what is the market actually telling me? And what does that mean for the choices I'm making today? That shift in perspective is what turns noise into insight. And insight is what changes everything. If this kind of cause and effect breakdown helps you see markets more clearly, subscribe. We're here every morning and evening with the stories that shape your world. See you in the next one.